The economy roars, but growth is set to slow as rates rise. Now, a boom in exports and continued strength in household spending drove the economy to new heights in June. The economy actually grew by a respectable 0.9% in June quarter ending, and the data actually, which was released only yesterday by the Australian Bureau of Statistics, showed that the real GDP growth rose from 3.3% to 3.6%. Now, the economy had a very solid quarter in June, and GDP over the second quarter was essentially not impacted by the RBA rate hikes. Indeed, the headline results indicate the Australian economy had plenty of momentum when the RBA embarked on their tightening cycle, and the landscape will change from here given that the Reserve Bank has delivered over 2.25% rate increases over the last number of months, and effectively what we're going to find is that this tightening of cash rate, where the Reserve Bank will continue to increase rates, will slow down consumer demand. The consumer actually powered the expenditure side of the economy over the second quarter of 2022, where household consumption rose by 2.2%, following similar increases that we saw in the first quarter of the year. Now, according to ABS, spendings on discretionary goods and service increased by the largest amount by 3.9%, and mainly due to transportation services, which rose by 37% as overseas travel picked up. Now, non-discretionary spending also rose by 1%. These outcomes are based on the volume of expenditure and run contrary to prices side of the economy. Now, consumers have clearly been on a massive spendings boom post lockdowns, and in a large part has been financed by pent-up demand and accumulation of savings. Now, having a look at some of the data, we know Commonwealth Bank has recently said that there is a 3-month lag between when the Reserve Bank makes a change to the cash rate and when it officially hits the back pocket of consumers. As we can see here, when the Reserve Bank made their 0.25% increase on the 4th of May, it took 1 month for the banks to recast the minimum monthly repayments, another month, 32 days notice for consumers to be notified. And then really in that third month, depending on the next payment cycle, is when that actually hit the bottom line. So we can see there is a 3-month lag period between these rate hikes. And that has a lot to do with what we've seen here with this recent data. A lot of the Reserve Bank rate hikes haven't really taken bite yet. We can see the rates increasing really the last 5 months in a row with the Reserve Bank meeting up. And looking at the GDP growth, we can see that a lot of it has been driven by private demand and our net trade. And that's been a huge contributor to the growth of GDP. We can see exports made up a huge contributor. Imports were actually quite low in comparison to previous periods. As we look at the data, we can really get a bit of a better understanding on what's driving it. Mining being a large contributor for the last 2 quarters, and even non-mining to an extent really picking up this quarter alone. So definitely interesting to see the data and how it's coming through, and the seasonally adjusted savings ratios, that's on the downwards. We're getting closer to post or pre-pandemic levels in terms of spending. And if we look at the industries, we talked about accommodation and food and services making a large part of that, transportation as well. And we can see the breakdown of the seasonally adjusted volumes based on the details here. Now, what we have been warned by experts and the RBA is that the economic growth is predicted to slow as interest rates actually take bite and cost of living pressures force households to cut back. And we've really seen some pretty extraordinary spendings given the last 2 years of pent-up demand and what that's really done to the economy. Now, as we can see here, growth in activity was driven by continued strength in household consumption, which increased by 2.2% in June and is now 6% higher over the year. And the biggest increase in spendings was at cafes, restaurants, and transportation services, as spendings on clothing and footwear also rose as well. Now, household spending on travel increased since borders have reopened, and the ABS has said there's actually more room for movement in this area and potential growth. Households are still only spending 2/3 of what they were pre-pandemic. Now, as we can see here, the saving ratios have declined to 8.7%, which is the lowest level since December of 2019, and suggested that consumers were returning to normal pre-pandemic rates of savings. It's also expected that savings rates will continue to fall and get down to pre-pandemic levels, where they were hovering in around that 5%. Overall, household consumption contributed to 1.1 percentage points to the overall quarterly growth of GDP, and that was driven mainly by discretionary spending on goods and services. We also saw a boom in net exports, which lifted a GDP a further 1 percentage point, and this was mainly due to the broad-based strength across the mining and rural goods sector. The RBA expects GDP growth to slow in the years ahead as a combination of rate increases and inflation stymie activity. Now, the central bank expects GDP growth to slow down to 2.3% in June 2023 and then down to 1.8% in June 2024. Some are even saying the cost of living crisis appears to be exaggerating, and judging by the national accounts, with the economy growing by 0.9% in June, some might actually believe it. But once again, we've got to remember that lag effect we talked about earlier, where it can take up to 3 months for the Reserve Bank rate hikes to actually hit the bottom line for consumers' back pockets. And consumer spending was increasingly strong in the last 3 months to June, as we saw shoppers opening up their wallets to travel overseas, go to hotels and cafes and restaurants. As we talked about earlier, consumer spending was increasingly strong in the last 3 months to June, and rising inflation and higher interest rates have done little to really deter that right now as it stands. But keeping in mind, we've got to allow for that lag effect to really take place and take bite. A broader measure of real wages show that they were rising in the middle of this year, contrary to the common complaint that real wages weren't actually increasing, with the average hourly earnings rising 4.8% through to this year. We have seen the global economy deteriorating, particularly with Britain, Europe, US, and China, and part-time and casual employees are working more hours and wages are definitely picking up, with part-time and casual employees working more hours and wages definitely picking up in the second half of this year. We saw retail spending hitting a record level of $37.7 billion in stores July this year. Wesfarmers, which owns Bunnings, Target, Kmart, and Priceline, and Harvey Norman have all reported continued robust sales. Booming commodity export prices delivered a record $43 billion trade surplus for the last 3 months, and the Reserve Bank Governor Philip Lowe signaled on Tuesday that there are several more interest rate rises in the coming months ahead, and consumer demand is running too far ahead of supply, and the labour market is already increasingly tight. Money markets have tipped the cash rate to exceed 3% by December this year, and no one's pretending that the path ahead will be easy, but the economy's starting point is better than many in the media are suggesting.